URG missed consensus on the bottom line for Q2 2026,
Yeah, they reported a loss of negative 4 cents per share.
which missed that negative 3-cent consensus estimate.
Right. Though on the top line, revenue was actually a slight beat.
Barely. I mean, coming in at $14.37 million against a, $14.36 million estimate.
Yeah, essentially in line.
Yeah.
But the number that completely shook the market, the one everyone is talking about, was their forward guidance.
Oh, absolutely. Management significantly lowered their full year 2026 delivery guidance.
Slashed it, really. From 1.3 million pounds of U3O8 down to just 1.0 million pounds.
And projecting what, $64.0 million in sales revenue for the year?
Exactly. And the market reaction was immediate and punitive. Shares fell 4.9% right out of the gate.
Trading down near $1.34, right?
Yeah, and what followed was just a multi-session bleed across both the TSX and the NYSE American.
Because investors were actively digesting this really difficult combination. You have a delayed operational ramp-up.
And a severe cash burn.
Right, a burn that entirely overshadowed that tiny revenue beat.
Definitely.
So if you are a retail investor looking for a tight, no-nonsense financial recap of this quarter, you are in the perfect place.
We're going to cut through the noise today.
We are. We're looking at the physical operations driving these numbers, and we'll figure out what it actually costs to pull uranium out of the ground in 2026.
Let's start with that $14.37 million top-line figure.
Yeah, to understand how they generated that revenue, we really need to look at the dirt.
Specifically, their dual-site operations out in Wyoming.
Right. To map this out physically, you have to look at their flagship project, Lost Creek.
Operationally speaking, the site actually had a massive quarter. They drummed a record 140,873 pounds of U3O8.
Wow, so that is a 47.4% sequential jump from the first quarter.
Yeah, and up 25.7% year over year.
And as for what physically left the facility, I think they shipped 149,747 pounds.
They did. And the mechanics of how they achieved that record production at Lost Creek are actually really fascinating.
It's all about that brand new sand filtration system, right?
Exactly. For anyone who hasn't dug into the weeds of in situ recovery or ISR mining flow rate is your absolute lifeblood.
Right, because unlike conventional mining, where you are, blasting rock and hauling it away in dump trucks,
ISR is totally different. You're pumping an alkaline solution deep into the ground.
to dissolve the uranium directly within the sandstone.
Right, and then pumping that uranium-rich fluid back to the surface.
But the challenge with that process is that those underground formations are incredibly porous, right? They're filled with fine particulates.
Yeah, tons of it. So before this new system, sand and silt would constantly get pulled up with the fluid.
I read it acts like a massive hairball in a drain.
That's exactly it. It clogs up the ion exchange columns and completely fouls up the resin beads used to capture the uranium.
So the plant is basically physically choking on the sediment.
Right, which forces you to slow everything down. You just can't pump as fast.
And that's where this new sand filtration system changes the game.
It essentially clears the drain before the fluid ever hits those delicate resin beads.
Removing that processing bottleneck. So URG boosted their flow rates from about 2,500 gallons per minute.
All the way up to between 3,200 and 3,300 gallons per minute.
Which is huge. Pumping, 800 extra gallons of fluid through the plant every single minute?
Yeah, and that directly translates to capturing more uranium.
Which brings us to their second operational site, Shirley Basin.
Right, the asset that is basically anchoring their long-term growth story.
In late June, Shirley Basin finally received state regulatory authorization to commence full operations.
And prior to that permit, they were restricted to a highly limited capacity.
But they still managed to capture 10,634 pounds during the second quarter.
They did.
So let's unpack the relationship between these two sites, because it's really the core of URG's entire business model.
You can think of it like a central kitchen and a satellite restaurant.
Okay, I like that. So Lost Creek is the central kitchen.
That's the hub.
Mhm.
And Shirley Basin is the satellite, the spoke.
Because in a traditional mining setup, you'd have to build a multi-million-dollar processing plant at every single well field.
Exactly. Which is incredibly capital intensive. URG sidesteps that.
So at Shirley Basin, the dissolved uranium is captured onto resin beads.
Right, and then those loaded beads are loaded onto trucks and physically driven over to the central kitchen at Lost Creek.
Where all the final processing, the drying, and the drumming happens.
Yeah, the design is supposed to keep marginal capital expenditures incredibly low.
Because you aren't duplicating heavy infrastructure at every site.
The theory is beautiful.
Hmm.
You build one expensive processing facility, and then you just feed it with cheap satellite well fields.
And here is where I really have to look at the income statement and push back hard on that narrative.
Go for it.
If trucking resin in a hub and spoke model is so incredibly capital efficient, why did the company miss EPS expectations by 33%?
That is the million-dollar question.
I mean, why is the bottom line bleeding if the infrastructure is supposedly already built?
That tension is exactly what is driving the stock price down right now. To understand the EPS miss, we have to surgically separate the unit economics from the actual cost of scaling.
Okay, break that down for us.
On a per-pound basis, the operations look healthy. During the quarter, they sold 215,000 pounds of uranium.
At an average realized price of $66.85 per pound.
Yes. And the cash cost to produce that uranium was reported at $40.20 per pound.
Okay, so a roughly $26 gross margin per pound. That sounds fantastic on paper.
It does. But that cash cost is creeping up. It was only $37.51 in the first quarter.
Oh, wow. So we are seeing margin contraction happening in real time.
Very much so. The product profit margin dropped from 31.2% in Q1 down to 14.3% in Q2.
That is a massive drop.
And when you look further down the income statement, it gets worse. The net margin collapsed to a deeply negative 252.75%.
Negative 252%.
Yeah, pushing their return on equity down to negative 105.96%.
How does that happen when your unit cost is $40 and you're selling for $66?
Because the stark reality is that the cash cost metric is incredibly narrow.
Narrow how?
It only measures direct operating expenses. So the chemicals, the electricity to run the pumps, the hourly labor at the plant.
Right, the day-to-day stuff.
Exactly. It deliberately excludes the massive amount of capital required to actually drill the wells, lay the miles of piping, and build the header houses in the first place.
Which perfectly explains the balance sheet bleed we saw.
Yeah, it's brutal. Unrestricted cash plummeted by $27.5 million in a single quarter.
Dropping from $122.8 million down to just $95.3 million.
In 90 days.
So I really struggle with management's low-cost producer narrative here.
It's a tough sell right now.
I mean, producing a pound of uranium for $40 is a great headline, but burning through $27.5 million tells a story of aggressive, heavy capital expenditure.
Capital expenditure that is completely invisible if you only look at gross margins.
Right. So where is all that cash actually going?
The development of Mine Unit 5 at Lost Creek is basically a capital furnace.
A capital furnace? Wow.
Getting these new well fields operational requires millions of dollars in upfront drilling and construction.
And all that happens before a single drop of uranium-rich fluid ever comes to the surface.
Exactly. However, look, we do need to contextualize the GAAP accounting distortions here.
Okay, yeah, let's get into that.
Because the headline $16.7 million quarterly net loss is heavily skewed by factors completely divorced from actual mining.
And this is a major stumbling block for a retail investor trying to read this income statement.
It's very confusing.
A huge portion of that $16.7 million loss is tied to non-cash derivative fair value swings.
Right.
Help us understand the mechanics of this. Why does a derivative swing create such a massive paper loss?
Okay, so Energy carries $120.00 million in convertible notes on their balance sheet.
Debt that can be turned into stock.
Yes, because those debt notes can eventually be converted into company stock. Accounting rules view them as a complex financial derivative, and the company is forced to recalculate the value of that embedded stock option every single quarter.
I see. So it's tied to the stock price?
Think of it like holding a rain check on a volatile asset. If the underlying stock price moves, or if market volatility spikes, the theoretical cost of honoring that rain check fluctuates wildly.
So the accounting rules force them to record those wild fluctuations as a loss on the income statement.
Exactly.
Even though they aren't actually writing a check for that amount.
Precisely. Millions of dollars of that $16.7 million net loss are just paper adjustments to satisfy GAAP rules.
Meaning it has zero impact on their day-to-day liquidity?
Zero. But let's not let them completely off the hook.
Right, because the cash still dropped by $27.5 million?
Exactly. Even when you strip away the derivative noise, the elevated wellfield development costs at Mine Unit 5 are a massive, very real drag on their physical cash reserves.
That sets up a fascinating dynamic when we look at management's commentary.
It's quite the contrast.
We have a severe quarterly cash burn, creeping unit costs, and a market that just completely punished the stock.
Yeah.
Yet on the earnings call, CEO Matt Gilley was projecting absolute confidence.
He really was. He actually called Q2 an inflection point.
An inflection point.
Yeah, framing this exact quarter as the moment Energy transitions into the largest and fastest growing domestic ISR uranium producer.
So he isn't apologizing for the massive capital spend.
Not at all. He views it as building the foundation for total dominance in the Wyoming uranium district.
And I guess that confidence is rooted in the physical reality of the assets.
It has to be. They have the permits, they have the processing plant, and they definitely have the uranium in the ground.
But getting the uranium out of the ground at scale is proving a lot more complex than they anticipated.
Which brings us to the most controversial part of the guidance update, the deferral strategy.
This is where the story gets incredibly layered. Management consciously lowered their 2026 delivery guidance by 300,000 pounds.
They basically took 300,000 pounds of contractual commitments they were supposed to deliver this year and just pushed them out.
They deferred 150,000 pounds into 2027.
And shoved another 150,000 pounds all the way into 2029.
And alongside delaying those physical deliveries, they are actively pulling the emergency brake on certain capital projects, too.
They really are. They decided to defer a planned $5.3 million wastewater treatment facility at Shirley Basin,
pushing the construction into 2027.
purely to protect their near-term cash runway.
And hanging over all of this like a dark storm cloud is a looming loan settlement.
Oh yeah, the Q4 loan.
Right. In the fourth quarter of this year, Energy has to return 250,000 pounds of uranium to settle a previous inventory loan.
And at current realized prices, that is roughly $16 million worth of physical product they have to drum up and hand over.
Receiving absolutely zero revenue in return.
It's like paying off a massive credit card debt using fiscal yellow cake.
That is a great way to put it. And when you look at the pressure of that Q4 loan, the 300,000 pound deferral starts to make a lot of sense.
It's almost got a necessity.
But I have to question the underlying motive here. Is this a brilliant strategic hoarding play? Or is it a sign of severe distress?
It's tough to untangle.
I mean, are they deferring those deliveries because they are genuinely struggling with the well field ramp up at Mine Unit 5 and just simply don't have the physical pounds to ship? Or is management looking at the geopolitical landscape and betting that domestic utilities will pay a massive security of supply premium in 2027 and 2029?
Look, the reality of the uranium market right now suggests it's a combination of both.
Okay, so a bit of both.
Operationally, scaling Mine Unit 5 and bringing Shirley Basin fully online is proving to be a serious slog.
It's definitely taking longer.
Right, so by deferring 300,000 pounds of commitments, management instantly relieves the pressure on their engineering teams.
Giving them some breathing room.
Exactly. They don't have to produce at breakneck, inefficient speeds just to meet a deadline.
Yeah.
It lowers their operational risk profile tremendously.
But the market dynamics are playing a huge role too, right?
Oh, absolutely. On the call, management explicitly discussed how utility buying behavior is shifting.
Right, because power companies are no longer just browsing the spot market for the absolute lowest price per pound.
They're terrified of supply chain disruptions.
The geopolitical situation is definitely driving that fear.
With heavy uncertainty surrounding supply from Kazakhstan, Niger, and Russia, U.S. nuclear utilities are actively prioritizing domestic, secure sourcing.
They need absolute certainty that the fuel will actually arrive.
Exactly. By pushing pounds into 2027 and 2029, Energy is positioning that uncommitted inventory in a future window where they strongly believe domestically sourced uranium will command a huge premium over foreign spot prices,
So management is defending the cash burn as a temporary growing pain.
while positioning themselves for a future domestic premium, yeah.
Let's contrast that optimistic long-term vision with how Wall Street is reacting today.
Oh, the sell-side research community is tearing these numbers apart.
They really are. The analyst reactions over the past week perfectly reflect the tension here.
Between Energy's long-term district potential and their short-term operational pain.
Right. And the downgrades hit the near-term models immediately.
Northland Securities cut their fiscal year 2026 EPS estimates from a loss of -15 cents down to a loss of -18 cents per share.
And they specifically pointed to the delayed margin recovery curve.
Northland is effectively telling clients that the frictional costs of scaling these well fields are going to drag down earnings for a much longer period than the street previously modeled.
We also saw H.C. Wainwright step in and cut their price target from $2.30 down to $2.20.
But the fascinating detail there is that they maintained their buy rating.
Right. Even at a reduced target of $2.20, based on where the stock was trading post-earnings, that still implies a roughly 56% upside.
And that implied upside highlights that the bull case on Wall Street is still very much alive, despite the EPS miss.
Yeah, RBC Capital maintained an outperform rating with a $1.75 target.
And Alliance Global Partners kept their $2 target totally intact.
So the consensus among the bulls is that the Shirley Basin ramp-up will eventually validate the whole hub-and-spoke model.
They fundamentally believe the central kitchen strategy works. It just needs time and capital to reach scale.
So let's synthesize all of this for the retail investor listening right now. We have glaring near-term risks.
There's the ongoing execution risk of physically bringing Mine Unit 5 online by year-end.
There is the continuous cash drain of development capex bleeding the balance sheet.
And of course, there's that massive Q4 inventory loan repayment where £250,000 go out the door for free.
Yet analysts are acknowledging all of this cash burn and still maintaining buy ratings with targets 50 to 60% above current trading levels.
It's wild.
Are we basically looking at a classic show-me story here?
That is the perfect framework for understanding this stock right now. A total show-me story.
The institutional analysts look at the physical assets, the permits, the proven reserves in the ground.
The fully constructed processing plant at Lost Creek.
Right, and they calculate a very high terminal value.
They know the uranium exists, and they know Energy has the legal right to extract it.
But the equity market, the actual buyers and sellers setting the daily price, are heavily discounting that future value.
Because the present reality is defined by execution risk and capital dilution.
The market is essentially telling management, look, we see your vision for district-scale dominance.
But until that $27.5 million quarterly cash burn turns into actual positive free cash flow, we refuse to pay a premium.
Exactly. They need to see the math work in the real world, not just on a spreadsheet.
So what does this all mean for you, the investor trying to navigate the uranium space?
It comes down to a massive macro question regarding the future of the entire industry.
Right now, utilities are terrified of geopolitical disruptions.
They are prioritizing secure domestic supply over short-term price optimization.
If the United States nuclear industry is truly forced to decouple from foreign supply chains in the coming years,
will Energy's massive, painful upfront capital spend today translate into an untouchable economic moat tomorrow?
That's the real bet. The capital efficiency of the hub-and-spoke model was never about avoiding costs today.
No, it is entirely about controlling the market tomorrow.
If that central kitchen at Lost Creek is fully built, permitted, and running at maximum capacity,
while competitors are still spending years fighting for regulatory approval,
then that early financial pain might just be the inevitable price of dominance.
It's the ultimate long game. You suffer through the cost of building the kitchen today so you can cheaply franchise the restaurants tomorrow.
Well said.
Make sure you follow the show so you never miss a deep dive into the financial realities driving the market. We will see you tomorrow.